All right, so we talked about the scalability of macro, and now we're going to get into the resilience of the strategy. And it's lasted the test of time for sure. And this is one of my favorite lectures of the entire course, because when I first learned about how resilient the strategy was and the data from way back in time that supported its resilience and robustness, it really sold me on why I should trade the markets with global macro. So resilience is a very overlooked part of investing and trading. All right, and we saw from the first section with the investment calculator, true big time wealth is built over the long haul with compounding. So your strategy needs to work long term to make a life-changing difference. A lot of people are focused on making 100% next year or 600% next year or something like that, when it's really about delivering solid returns both in up and down markets for an extended amount of time. It's very, very important. Now, global macro succeeds by finding trends, plain and simple. If macro is going to work, it needs trends. And the good thing is trends have existed since the beginning of time because human nature has never changed and will never change. And this is a cool little comic, pretty funny, about how human emotion can start a trend. And so if you see in the up top left, you got a guy saying, I've got a stock here that could really excel. And the next guy says, really excel, sell. And it becomes a herding mechanism. And everyone's just doing something because the other guy did it, and stuff starts to trend. And then same thing in the bottom. You have sell. This is madness. I can't take it anymore. Goodbye. Then you have goodbye, buy. And the whole thing starts over again. All right. And this might just be a comic and a little unrealistic, but in reality, this is what happens. Okay. We are, as a race, we herd, and there's a lot of crowd psychology that goes into how we operate. So when you take the emotions and you take the crowd psychology and you take the fact that we're habitual creatures and it's very hard to kill off our habits and our incentives haven't changed since the beginning of time, you get this robust framework of human forces that react to create boom-bust cycles. And it's these boom-bust cycles that birth trends, especially so in financial markets. And so here's a graph. You guys might have seen this before, but it basically outlines the various emotions on a particular trend. So it starts off on the left there with optimism. Pull up something here so you guys can see it real quick. So optimism. As the trend continues, we get excitement, and then a lot of people start making a lot of money. We get the thrill, and then finally at the very top, this would be like the 99.com boom, you get to euphoria. And then after that euphoria, it starts to die down again. We hit anxiety, then we go to denial. Finally, people are losing a lot of money. We get fear, desperation, and that leads to panic selling. And finally, at the bottom, we're in despondency. And then the cycle just repeats itself. We come out of despondency and we go into a minor depression that gets replaced by hope, relief, and we're back to optimism. Okay, and this emotional cycle happens again and again in the financial markets, and it's the reason why assets trend one of the reasons why assets trend in the first place. So we've observed this type of boom-bust cycles at the beginning of time. And what really opened my eyes was when I read about references to cycles all the way back to the Bible in the book of Leviticus. It's unbelievable. They call it the year of Jubilee. It was about a 50-year economic cycle, and you can research more about it if you're interested. But people have been writing about boom-bust cycles forever. Here's another example of a boom-bust cycle. This is in the 1700s, and you could see... pull up this pen again. Whoops. You can see here, Newton bought South Sea stock right here. South Sea stock was one of the first famous stock market bubbles back in the 1700s, and he made some good money and exited, but then the price kept going, and his friends got rich. He was getting jealous of his friends, and then it kept going, and he had fear of missing out, and he finally just had to buy more and get caught up in the crowd psychology and the emotion of the trend, and then, of course, it all just falls apart, and he exits for a huge loss. Okay, so even a guy like Isaac Newton, a guy who invented calculus, one of the brightest minds to ever exist, he still got caught up in the boom-bust cycle. It's hardwired into every single one of us. Here's another example of the business cycle in the US and how that carries over to create boom-bust cycles in the financial markets. So the US GDP gap, which is pictured here, and you can see it's very cyclical, basically above the 0% line, above this 0% line right here, means that the economy is overheated and we're producing more than what we should be, usually via loose credit. And below the 0% line down here, it means we're producing less than what we should be. So instead of, just a nice stable zero line, us producing what we should be every single year, you have this boom bust cycle. Okay, so some years we're underperforming, other years we're outperforming, and we don't have this nice steady line. And this has been, going back since the 1960s here when this data was put into the graph up to around 2010. So, this is just a good picture of the cycles that are in the financial markets and will continue to be. And finally, the whole machine, Wall Street and finance in general, relies on this boom bust cycle and trending to sell the next hot thing for fees and commissions. Okay, they need to hype the good performing assets to keep the lights on. We all know how the game works. All right, so these guys on Wall Street, they know that people want to chase performance, so they find whatever the hottest product is. In 2007, 2008, it was subprime mortgages. It's in the 99 period, it was internet stocks. It's basically the flavor of the month, whatever's doing best, and the crowd and the herd piles into the best performing stuff, and these guys know it, and they continue to push it and sell it, which exacerbates trends even further. So the modern financial system is just full of bankers and investors constantly trying to chase yield and performance for their clients, to make sales, etc. So they exacerbate this entire boom bust cycle and the nature of markets that creates trends. And another reason why macro is resilient, besides the fact that that there's data going back since literally the Bible that says there's boom bust cycles that exist in markets which create trends, it's the mobility to move around between markets and hit the best trends. So in global macro, you do not need a bull market in stocks to make money. And a lot of people out there just focus on the stock market, but if the stock market's not doing well, what are you going to do? You're going to sit on the sidelines for 20 years? Stocks can go into extended bear markets, and it hasn't happened recently, so people forget. And I want to pull this graph up. It's really interesting, but this is the Dow Industrial Index, and it starts in 1963 and it goes to 1983. And you can see, what did the market do? Nothing. We just remain range bound for 20 years. Okay, so if you're in a market like this where stocks are just going sideways and they don't happen to be trending because markets aren't trending all the time, what do? Do you just try to play the stock market and not make any money for 20 years? I mean, you saw how much that could kill you on that investment calculator. You need to be pulling returns year after year for many, many years. It's that compounding that really gets you to the prize at the end of the journey. So by monitoring the entire world, you can move away from the range-bound markets and enter markets with trends. And those could be in commodities, those could be in interest rates, those can be in Forex, it can be in precious metals, or even in foreign markets. And this is a great example to show how you could continue making money with the global macro method had you been paying attention to other markets. So this is back in 1970. So around the same time we saw in that other graph, just a little bit later. And this is a graph of gold. All right. The precious yellow rock gold. And I adjusted it for inflation here so it's a little bit easier to see and compare. But look, so while you were range bound in equities, you had huge bull moves in gold. And this was due to a lot of the inflation at the time in the market. But you have the ability to hop on these trends and really hit them hard if you're paying attention to macro and are able to move around to any type of market. You don't need to sit in equities for 20 years and watch the account trade sideways. You can hit breakouts in gold. We've seen how you can move around to the markets that are trending. We've seen that boom bust cycles and trends have existed since the beginning of time. And we had documented success of macro traders all the way back to Livermore in the early 1900s that have been using the method to their success. So the amount of time that the strategy has been around is a testament to its resilience in all market environments. And that's it for section 2, guys. I hope you really enjoyed it. So the main takeaways that you should really come away from this particular section with is that global macro trading is highly scalable. We talked about penny stocks, small caps versus the macro instruments, how there's so little money exchanging hands in those markets. You can't really get a big account into those markets. So if you learn a strategy only to have it be able to handle 100,000, that's pretty worthless. I mean, it might feel good for the first couple of years, but this game is about staying in for the long haul and scaling your assets. You don't have to worry about your strategy failing as your AUM grows with macro. And taking a global macro approach to markets is highly resilient and robust. We talked about the we talked about the scalability factor, we talked about the resiliency factor, and the method it profits off of comes from human phenomena that have been occurring since the beginning of time, all the way back to the Bible. And we saw the examples with Newton, etc., in stock market bubbles there. Trends and cycles will never go away. Okay, so you don't have to worry about the strategy all of a sudden fizzling out and not working. And if there's no trend in one market, global macro is the ability to jump to a different market entirely. And our example was the stock market in the 60s to the 80s and gold. So I hope it can instill into you guys why this method can work so well for the long haul.